Now, let us look at how investors or people outside of business use the financial statements that the business produces to determine whether they should invest money in that business, lend money to that business, or do business with that business. The only thing they have to go by is what the income statement, which is the revenue and expenses and profitability of the business, and the balance sheet, which tells us what the business owns, who it owes, and how much investment the shareholders have in the business. Using those statements now, we now apply what's called ratio analysis. Now, ratio analysis is a way of expressing a relationship between different parts of both financial statements. A ratio is simply a mathematical relationship between one quantity or one part of the income statement or balance sheet and the other part of an income statement and balance sheet. And this relationship is a series of ratios that we are just beginning to introduce now. These ratios are actually in three categories. One, there's the profitability ratios. That measures the income and the operating success of the business. That's your income statement here. Revenue minus expenses gives me my net income. Then there are the liquidity ratios. These answers the questions, what short-term ability does this firm have to pay its obligations? And that, of course, is the liquidity. We look at the current assets and we relate them to the current liabilities. The current assets being what we have in cash or near cash to pay our current liabilities, our accounts payable, our salaries payable, and so on. Then we look at it and there are ratios that are more long-term in nature. They measure the ability of the company to survive over the long term. Those are our debt-to-equity ratios or debt-to-total asset ratios. These are the three categories of ratios. Now we're going to introduce them now, and later on we will add more ratios in each of these categories. Now, one of the first questions an investor would ask when looking at the financial statements of a company, what are the earnings? And if I invest in this company and own a share of the company, then what would the earnings per share be, or better known as the EPS? And this measures the net income earned for each share of common stock. Remember, common stock represents ownership in the company. Here we have Best Buy, 2009, 2011. Net income, both years. The amount of shares, 2008, they started off with 481,000, they went down to 411. 2009, they went up to 414. Now, in calculating the earnings per share, the investor would take the net income from the income statement minus any preferred stock dividends. Now, we're not going to come across stock dividends at this level. That would be later analysis. And we would relate that to the average common shares. So therefore, in 2008, the net income was 1407, no preferred shares. The average share at the beginning was 411, at the end 482, so we add those two together and divide by 2. And we see that the EPS in 2008 was $3.15 for every common shareholder. Now, in 2009, or every common share that a shareholder would own. In 2009, again, earnings per share is the net income minus the preferred dividends and the average amount of outstanding shares. And the earnings per share in this case is $2.43. So you can see it went down considerably. And that would be a concern for people reading the financial statements. But you see, you wouldn't see this and just look at the financial statements. You'd only begin to see it when you relate the earnings to the number of outstanding common shares. Now, in profitability ratios, of course, we are looking at the income statement. In this case, in liquidity ratios and the solvency ratios, we use the balance sheet. Now, liquidity ratios, of course, relate the current assets, that's the cash or near cash items, to the current liabilities. And later on, when we look at who owns these total assets, we're going to do solvency. We're going to relate the amount of long-term debt to the total amount of assets and see how solvent the company is. And the first question is a question of liquidity, and that is, liquid means the most liquid asset is cash. And we presented the current assets in the order in which they turn themselves into cash. Recall when we did that and lectured on classified balance sheet. And in that way now we can relate the ability to pay the current liabilities by looking at the current assets related to current liabilities. So let's go back and look at Best Buy. Current assets in 2009 was right here, 8,192, 8,192. But look at the current liabilities, 8,435. So they have more liabilities than they have in current assets. And so the difference between the current assets and the current liabilities is what is called in business working capital. Now be careful of this term capital. It comes up a number of times in accounting. And I tell you, accounting is the language of business. You have capital equipment, the capital invested in a company. You have to be careful of the definition. What does a person using the word capital actually mean? When they use the term working capital, it means the excess of current assets over current liabilities. And as I showed you in the past, in the previous screen, there is no excess. There is a deficit. And so when the working capital is positive, there's a good likelihood to pay its debts, but Best Buy has a negative working capital of 243. That is, the liabilities are 243 million more than the current assets, and this is very serious. So for liquidity ratios, we look at working capital, and we also look at what's called the current ratio, and that's simply the relationship of current assets over current liabilities. If the current assets equal the current liability, the ratio would be 1 to 1. Well, in this case, the current assets 8,192, current liabilities 8,435. That's 0.97 to 1. And so therefore, for every dollar of current liability, Best Buy has 9.97 cents of current assets in order to pay. And compared to last year it was $1.08 to 1. So you can see that they're having more difficulty here with the liquidity ratio. It has gone down considerably. Now the other thing about ratios is they really take on meaning when you compare them to other companies or industry average. In this case over here, we compared it to the year before, 2008. Now if we compare it to our competitor, H.H. Gregg, in 2009, look, they had $1.68 in current assets for every dollar of liabilities. Now there are companies that do industry averages, and they present those industry averages, it's called the Dow Industrial Averages. And they present industry averages, and you can look at your industry, and for all companies in your industry, the average current ratio is 1.5 to 1. So from this you can see if you're management of Best Buy, you have a problem here. And you may have a problem in paying your short-term debts. If you're an investor, you'd be kind of concerned about this. But that's what the liquidity ratio helps you look at. Next, we look at solvency. And using the balance sheet again, solvency is the ability to pay the interest on your debt as your debt comes due. Now this is long-term debt. Solvency ratio measures the ability of the company to survive over a long period of time. If you're solvent. If you're insolvent, that means you are bankrupt. So, of course, you don't want to do business with a company that's going to be looking at bankruptcy possibly in the future, and this is why you look at the solvency ratios. Now, a key solvency ratio is the company's total debt, or that is total liabilities, as a relationship or ratio to total assets. So, the formula here is total liabilities over total assets. And looking back at the financial statements, you can see here total liabilities, 11,183,000 over total assets, which is 15,826,000, the same as up here. As compared to last year, where we had total liabilities 8,274, total assets 12,758. So now when we look at Best Buy, we have total liabilities 11 $5,153,000 over total assets, $15,826. So you can see that 71% of the assets are owned by people outside the business. Now, how does that compare to last year? Last year was 65%. So the shareholders owned more last year than they do this year of the total assets. Now, how does that compare to the industry? Well, the industry is around 64%. Not the industry, the competition. The industry is 57%. So this ratio means that for every dollar of assets, it's financed by 71 cents of debt. And that is your solvency ratio. So again, to recap, 3 categories of ratios. Profitability, here we look at earnings per share solely at this point in time. Then liquidity ratio, you must know working capital and the current ratio. And the solvency ratio to date now would be debt to total assets. And that's how investors would begin to look at and analyze. They try and get under the skin of the corporation by using the balance sheet and income statement and comparing one part to another. And for the rest of the course, we will slowly introduce more ratios. How? So you see how important it is in producing financial statements that you follow what's called generally accepted accounting principles. You present the financial statements the same all around the world because presentation is governed by these rules so that the investors can feel comfortable that these financial statements were presented in the format that is consistent with the way they understand financial statements.